Hey, welcome back to the channel. Long time no talk. It's been a while. Today we're gonna be checking out Cigna Group. I've been looking at this over the last couple weeks and found it pretty interesting. So, getting in the 5-year chart, we can kind of see we've had a range of 120 to 330 from the COVID lows to the highs, and we're in a pretty nice pullback right now, about a 20% pullback, going from 340, sitting at about 252 right now. So yeah, for a 5-year chart, that's what we're looking at. Let's jump on into maybe the latest investor presentation. All right, so here we got the latest investor presentation. They should be reporting fairly soon, I think, in the next couple of weeks. So we'll get Q1 2023 in the next couple of weeks. So this is for Q4. We can see in 2022, they beat their kind of guided growth. They were guiding about 10 to 13%, and they had about 14% EPS growth. We can see in their Evernorth revenue segment, growth was about 6%, adjusted earnings growth about 5%, and they're targeting 5 to 7% growth long-term in that segment, which is where the Express Scripts acquisition kind of got bundled under. When we look at the Cigna Healthcare section, they had growth of about 13%, which was above their target of 8 to 10%. So we see that from these two segments, they're kind of long-term projections of 8 to 10% growth in the healthcare area, and then 5 to 7% growth in Evernorth, which is really more focused on their prescription fulfillment. And then here we can just kind of see that broken down, Evernorth versus Cigna Healthcare, kind of the two buckets that they have. So Evernorth be pharmacy benefit services, specialty pharmacy, core services or care services, and then Cigna Healthcare is U.S. commercial, government, and international health. Then we have a little bit of a revenue breakdown of kind of their legacy, not legacy, but their health insurance business accounts for about 60% of the revenue. And then they've got their pharmacy, Evernorth, accounting for about 40% of the revenue right now. So this is a pretty interesting segment. It just goes to kind of show the cash flows that they expect to generate over 2022 to 2026, about 50 billion cash flow, 10 billion for CapEx, 20% of the 40 billion going for dividends, right? 10% repay debt, and 70% share repurchases. So they are looking at doing a pretty significant amount of share repurchases, and their dividend is relatively new as well. So there's a good chance that we could see a decent amount of dividend growth from the massive repurchasing of shares and shrinking their float, and then also increasing the dividend payout as well. Okay, so I just looked at it again, and it looks like 70% for a share repurchase and strategic M&A. So it's kind of interesting because currently their stock is at about a 74 billion market cap, and just in looking at those cash flows for those 4 or 5 years, that's about 35 billion towards share repurchases and strategic M&A. If they don't get the M&A that they want to get, I mean, if the bulk of that is put towards share repurchases, then you could have a pretty substantial amount of share repurchases going on. That's about half of the market cap of the company right now, which is pretty insane. So then they get into kind of their long-term objectives to return value to shareholders. And we can see 68% earnings growth, 45% increase in long-term targeted average annual contribution from accretive capital deployments, and then total be about 10 to 13% in EPS growth plus growing the dividend. So we kind of get that EPS growth at a greater percentage based on the earnings growth, just because they are planning on buying back a decent amount of shares. And currently at the current valuation, that seems like a fairly good thing to focus on, since they're yielding about 10% free cash flow, I believe, to their market cap essentially right now. All right, so here we can see their kind of 2022 results versus their 2023 full year guidance. So 2022 adjusted EPS 23.27. In 2023, they are guiding for at least 24.6. So what is that? That's like a buck 30 per share or so increase. Then if we run the calculation on that, that's about 6% EPS growth. something like that. In their last earnings call, yeah, there we go. Couple deployments. So weighted average shares outstanding, 296 to 300 million. I think they're sitting at about 305 million right now. So they are planning on doing a decent amount of buybacks. That's probably going to be between 2 to 3% buybacks on the overall float. All right, so now if we get into the valuation side of things, pulled up my model here, and I'm looking at, let's see, we're looking at buybacks of about 3.8% per year to 1.99% per year across the various scenarios. Bottom line growth of 7% to 10%. We've got EBIT yield spread of 3.96 to 5.29, net yield spread of 3.95 to 5.27, free cash flow yield spread of 5.58 to 7.45. So that results in a kind of average bottom line fair value yield spread between 6.8 to 10.47, which is, or actually fair value yield, not spread, which is pretty, it's pretty low on the valuation side. We can see that, historically they've kind of traded between this like 10 to 5% area, and we're getting up to this 10% area right now. And that kind of is interesting because, if they're projecting to do 10% free cash flow or EBIT, if they have that much cash flow that they can put back into share buybacks, then they can decrease their float at a pretty decent rate and potentially increase their dividend at the same time. So they have the potential to be a very, very good kind of dividend grower, and also really take their share count down pretty drastically, which they have done. You can see that after that acquisition, I believe this was the Express Scripts acquisition. Right now we had a pretty big bump in shares outstanding, and then we also had a pretty decent bump in debt as they took on the debt for that acquisition. So from that acquisition, they came out with about 384 million shares, and we're sitting at 305 million right now. And then they're projecting to take that to 296 to 300. So that would probably be another couple percent. If we look at the kind of the yearly rates of their buybacks, it's kind of been opportunistic. So we see the massive amount of dilution of 50% right there on the acquisition. And then we have a 3% buyback, 8% buyback over the last 12 months, have been almost 10% in buybacks, I believe, if those numbers are correct as far as the percentage basis. So let's see. One, 2, 3, 4. Yeah, so pretty much went from 337 to 305. So a massive amount of buybacks over the last, 4 or 5 quarters. Now, if we go into the other metrics, so we do see that they just started a dividend in 2021. So this is a pretty relatively new dividend, and they have been growing it at a decent pace. So the other thing I was going to say is if we look at the per share metrics over time, they have been really, really good at growing bottom line metrics on a per share basis, operating cash flow per share, free cash flow per share, and net income per share. So over the last 10 years, they've had fairly steady growth of those per share metrics. And going forward, if their valuation is continued to kind of be hampered, and they're still trading at like an 11 PE or something like that, but they have all that cash flow, then we'll probably see a lot of per share metric growth just based off of the buybacks. Yeah, so this is a graph that I use for REIT metrics just to see kind of the health of the dividend, but this obviously is not a REIT, it's just that's where the graph is. So we can see the dividend is paid right here, 134 and 138, right? They didn't increase the dividend all that much on a total distribution basis, but because they brought down the float so much, it did increase the dividend on a per share basis. So you can also obviously see that they have a lot of room to increase this dividend as their operating cash flow and their net income is significantly greater than their dividends paid. Now, I kind of like the strategy that they have. of buying back a lot of shares while the stock price is depressed. Because if you're buying back a ton of shares, you're going to get dividend increases without even necessarily increasing the total amount paid to dividends, because you're going to have a less share count, right? So if you're using the same amount of capital to pay out in dividends, but you have 5% less shares, well, that's automatically going to be a 5% increase in dividend payout on a per share basis. So it's pretty interesting. This is one that I've been looking into for a little bit now. I think I looked at it back in the day too. Every once in a while, I'll like start looking at a stock again because it kind of took a fall or something, and it makes it jogs my memory. I'm like, oh yeah, this is this one. So yeah, I'm kind of new to healthcare stocks, but this is definitely looking pretty interesting. At least from the numbers standpoint, they seem to be on a pretty solid ground, and they seem to be in a position where they can really cannibalize their share count, increase dividends, and kind of be in control of their future of how they return value to shareholders. And then if the market by chance starts to become more bullish on them, we could see a decent amount of multiple expansion from them as well, right? So if we saw these trading back in the 5% range, 6% range, then we could see a lot of tailwinds to the share price just from multiple expansion. So right now, I'm targeting a 15% KR. It's got about 1.82% dividend yield, which is decent. Through using kind of this model that we went over previously, the specific areas, we get a bearish buy price of 215, very bearish buy price of 182, a base case of 256, and we're at 252 right now, so we're right within that base case scenario. The base case scenario is essentially doing a 2.5% buybacks, bottom line growth about 8.82%. So, and that would kind of make sense, right? That would be right in line with like their EPS guidance of, what was it, 13 to 14% or 10 to 13%, I think. So kind of right in there. And then for the multiples, we've got EBIT yield spread of 4.58, net yield spread of 4.56, free cash flow yield spread 6.45, going off of a risk-free rate of 3.21 to give us a bottom line fair value yield of 8.41. So that's kind of what I'm looking at. I'll be keeping an eye on this, and I'm probably going to start digging into more of their competitors, seeing if there are any major risks that I am missing. But yeah, Cigna Health looks like they are in a really good position to kind of return a decent amount of cash flow back to shareholders. So it's definitely intriguing me, and they have been doing that already through some pretty massive buybacks, and then the establishment of a dividend and the growth of the dividend. So yeah, pretty interesting. Let me know what you think in the comments. Join the Discord if you want to. Pretty cool group of people on there that we chat about different stocks and look at valuations and whatnot. So yeah, good to be back, and I'm gonna try to post videos a little bit more often if I get the motivation. So have a great day, and we'll catch you later.